Okay, let's begin. Today's training is brought to you by Kagiko and Associates, and our topic is Fast Track to Practical Accounting, focusing specifically on taxation. We'll be covering the basics of Kenyan taxes as administered by the Kenya Revenue Authority, or KRA. So we'll be explaining everything clearly, using practical examples, and drawing from real-life experiences. Let's get started. All right, let's talk about value-added tax, or VAT. So why is it called value-added tax? Well, VAT is a consumption tax that is applied on the value added at each stage of the supply chain. Think of it this way. A farmer grows crops, for example, some baby corn as shown on the screen, then sells it to a processor, who in turn sells it to a distributor, and finally it reaches the retailer before going to you, the final consumer. At each of these stages, value is added to the product and VAT is charged. Okay, so let's break down how VAT works in Kenya. VAT is a tax on the consumption of taxable goods and services either supplied or imported into Kenya. This means when you buy goods or use services that are taxable, VAT is included in the price. It's important to note that VAT is collected by registered persons, meaning businesses that are registered to collect VAT, at various designated points. They then remit this collected VAT to the Commissioner of KRA. Now, regarding VAT registration, it is voluntary if you supply taxable goods and services. However, it is mandatory by law once your business attains a taxable turnover of 5 million Kenyan shillings per year. Failing to register for VAT on time has consequences, such as a penalty of 20,000 Kenyan shillings, and you may be fined up to 200,000 Kenyan shillings, or even face imprisonment not exceeding 2 years, or both. Now let's delve into how VAT works in practice. There are two key terms here: input VAT and output VAT. Input VAT refers to the tax on goods and services that are charged to you by your suppliers when you are buying goods or services for your business. Output VAT, on the other hand, is the tax you charge your customers when you sell taxable goods or services. When it comes to paying VAT, you do not pay all the output tax to KRA. You subtract the input VAT from the output VAT, and the difference, if any, is what you pay to the Commissioner of Domestic Taxes. It's like you're only paying VAT on the value that your business actually added. Let's clarify when VAT is incurred, especially for those not registered for VAT. When you, a business, purchase goods or services, your supplier, who is registered for VAT, charges you input VAT. However, if a business is not registered for VAT, it should not charge VAT on its sales. They are essentially at a disadvantage, because they have to pay VAT on all the goods or services that they consume without being able to claim the input tax that they incur. If a business that is not registered for VAT charges output VAT, then they are breaking the law and they are subject to penalties. Does this help clarify when VAT is incurred and when it isn't? We can certainly explore this further. Okay, let's move on to VAT tax rates. In Kenya, there are three main VAT rates. The general rate is 16%, which applies to the majority of taxable goods and services. There's also a reduced rate of 8%, which currently applies to petroleum products. Then we have the 0% or zero rate. The zero rate applies to certain categories of goods and services like exports, agricultural inputs, pharmaceutical products, educational materials, and supplies to privileged persons, such as people with disabilities or those who are in the diplomatic corps. The purpose of the zero rating is to make these supplies cheaper, because the dealers in such goods are entitled to claim back any input tax incurred. This is slightly different than an exempt good. Do you have any questions about these rates before we move on? Okay, now let's talk about exempt supplies. These are goods and services that are specifically exempt from VAT according to the VAT Act. Exempt goods are listed in the second schedule of the Act, and examples include things like fertilizers, vegetables, and unprocessed goods. Exempt services, on the other hand, are listed in the third schedule of the VAT Act, and examples include banking services, educational services, and insurance services. Keep in mind that the dealers in exempt supplies, unlike those dealing with zero-rated goods, are not entitled to claim any input VAT that they incur. Are there any questions about exempt supplies at this point? Okay, let's discuss accounting for VAT. First, when you make a taxable sale, you must issue a tax invoice to your customer. This is a crucial part of the VAT process. Then there's the aspect of input tax deduction. This is where you claim back the VAT you incurred on purchases you made for your business. Remember that only registered persons for VAT can claim input tax, and they need to have a valid ETR or ESD compliant invoice, like the one shown on the screen. Also, the input VAT must be claimed within 12 months from the date of purchase. Finally, record keeping is very important. All records relating to VAT, such as invoices and receipts, must be kept for a minimum period of 5 years. Okay, let's talk about onboarding to eTims. eTims, or Electronic Tax Invoice Management System, is a system that KRA has implemented to manage tax invoices electronically. Essentially, it's a way for businesses to send their invoices directly to the KRA system in real time. This allows for better tracking of sales and tax compliance. For those who may not be aware, traditionally, invoices were either manually written or created using accounting software, with a copy only sent to KRA on a monthly basis. Now, with eTims, every sale that you make as a business is recorded instantly within the KRA system, offering more transparency and allowing KRA to accurately track your turnover. It also means less administrative overhead, like filing manual returns. Let's look at how to get on board with eTims. All right, let's dive into how to register for eTims using USSD code 222 hash. This is one of the easiest methods of getting onboarded. For those unfamiliar with USSD, it's basically the code you use to check your airtime balance or perform mobile money transactions directly from your phone. So, to register, you'll dial 222 hash on your mobile phone. Once you do that, you will see a menu where you'll select the eTims option. Then, you'll be guided through a few prompts to input your KRA PIN number. Once completed, you will receive confirmation that you have been onboarded. This method is quite convenient, particularly for those who do not have computers or internet access and are familiar with the system. It's a simple process and is the most used method of onboarding. After successfully registering through USSD, you can then proceed with your tax compliance, making sure you can generate your eTims compliant invoices when you make sales. Let's break it down. The ETR and the more recent TIMS were introduced by KRA to help businesses comply with VAT regulations and to help KRA to be able to monitor VAT transactions. Registered taxpayers are required to process all their invoices through these systems. This helps them to be able to claim input VAT and is mandatory for issuing valid tax invoices. Regarding filing VAT returns, once all your invoices are processed through TIMS, then you can file them through iTax. The system automatically picks the input and output tax for you, thus making the filing process easier. Is there anything more about TIMS or VAT filing that you'd like to discuss? Okay, now let's talk about the filing of VAT returns. VAT returns in Kenya are due on the 20th of the following month. This means, for example, that for your VAT transactions in the month of January, you will be expected to file your VAT returns and pay any taxes due by the 20th of February. As we have discussed, the VAT return involves subtracting the total input tax from the total output tax. The resulting amount will either be VAT payable to KRA, or it can be VAT creditable, which means you have paid excess VAT and KRA owes you. Okay, let's delve into a practical example of how VAT is accounted for. We will explore how journal entries are made, talk about the accounting systems, and how they are configured to account for these transactions. Also, I will discuss the example more extensively and how all of this information is then transferred to KRA. Let's start with the purchase invoice. Imagine you are a business and you purchase goods worth 10,000 Kenyan shillings, VAT, at 16%, which totals 1,600 shillings. In accounting, this would mean that you record the purchase of goods in your debit account, and the VAT as an in the purchase invoice example, the total amount is Kenyan shilling 11,600, which includes the 10,000 shillings cost of goods and 1,600 shillings of VAT. Then, let's look at the sales invoice. Okay, so let's move on to the sales invoice. In this scenario, your business sells goods worth 20,000 Kenyan shillings, and the VAT is 16%, which is 3,200 shillings. So the total amount is 23,200 shillings. Now, let's discuss the journal entries for both of these invoices. For the purchase invoice, we have to account for the cost of goods and also the VAT. Typically, when we purchase goods, the account that is debited is purchases, and the VAT input account is also debited. So purchases would increase by 10,000, and VAT input will increase by 1,600 shillings. The credit account could be either cash or account payable if you purchased on credit. Okay, now for the sales invoice, the journal entries will be a bit different. When you make a sale, you debit either cash or accounts receivable for the total sales amount, which is 23,200 shillings. You then credit your sales account for the actual sale of 20,000 shillings, and the remaining amount of 3,200 shillings will be credited to the VAT output account. Now, let's discuss the net effect when filing your VAT returns with KRA. In essence, KRA requires you to pay the difference between the VAT you have collected from sales and the VAT you have paid on your purchases. In our example, the VAT output is 3,200 shillings from the sales, and the input VAT was 1,600 shillings on purchases. This results in a net VAT payable of 1,600 shillings, 3,200 minus 1,600. Okay, so how does all of this connect to the iTax system and filing with KRA? Well, your accounting system should be configured to capture these transactions accurately, and most systems will generate VAT reports automatically. When you log into iTax, you will enter the total sales you made, which is referred to as the output VAT, and the VAT on purchases, which is the input VAT. The system automatically calculates what you owe or what is due to you. Then you are supposed to submit your VAT returns and make payments to KRA. I promise we will do another training on a practical case of how to file VAT on iTax. This will give you hands-on experience with the whole process. Okay, let's dive into digital supplies registration with regards to VAT. Basically, this is about how businesses that provide digital services like software or streaming need to register for VAT. All right, the next important point is that this registration is required irrespective of your annual turnover. This means that even if your digital business is small and does not meet the usual VAT threshold, you still have to register. Okay, great. And here's some good news. The registration process has been simplified. This means KRA has made it easier for digital suppliers to get registered without too much red tape. In practice, this involves online portals that make it easier for businesses to register. Now let's look at some examples of digital supplies or companies that need to register. This can include streaming services like Netflix, software companies providing cloud services, or even online marketplaces. Okay, let's now discuss VAT deregistration. The first reason for deregistration is when you've ceased making taxable supplies. This essentially means that your business is no longer involved in activities that are subject to VAT. Another common reason is when your business falls below the threshold turnover, which means if your business is generating less revenue than a certain limit, you might be eligible for VAT deregistration. The current VAT threshold in Kenya is 5 million Kenyan shillings per year. If your annual turnover falls below this amount, you can apply for VAT deregistration. Okay, another reason for VAT deregistration is when goods become exempt due to a finance bill passing. This means a new law has been enacted that changes the tax status of certain goods or services. Furthermore, if the business ceases operations due to death, dissolution, or insolvency, the commissioner should be notified so the business can be deregistered for VAT purposes. Finally, even after deregistration, you are still required to file returns until the obligation is officially removed or KRA advises you to stop. This ensures all your tax affairs are in order before you fully exit the VAT system. Okay, let's delve into VAT on imported services. It's also known as reverse VAT, so you may hear people use that term interchangeably. We'll cover who should pay, how to pay, and when it's due. Right, let's start with who should pay. Generally, it's the recipient of the imported service who is responsible for paying the VAT, not the supplier. So if you, as a Kenyan business, get a service from a company based outside of Kenya, you're the one who needs to account for this VAT. This is different from normal VAT, where the supplier would charge VAT to you. It's a way for the government to collect tax on services that are consumed within Kenya, even though they are provided by a non-resident. Okay, then let's move on to how to pay this VAT. You will essentially declare this tax on your VAT return. You'll need to include the value of the imported services in your return, calculate the VAT amount, and remit it to KRA. It is important to have an invoice that contains the value of service, the VAT amount, if any, and the details of the non-resident service provider. Do you have any questions on that aspect so far? Okay, let's discuss. When is VAT on imported services due? The due date for VAT on imported services is the same as the due date for your regular VAT returns. In Kenya, VAT returns are usually due by the 20th of the month following the month you made your purchase of imported service. You need to declare it and remit the VAT payment by this date.
Thank you for watching our video on VAT theoretical background. Our next video will be on withholding VAT. Please subscribe to our channel so that you can get notifications whenever we put new videos. Thank you so much. My name is Jason of Kageko & Associates, where we are true and fair. Thank you.
Let me know if you have any more questions.